Oil giant Chevron reached an agreement to buy rival Hess in a $53 billion all-stock deal, a sign of further consolidation in the energy industry. We saw Exxon buy shale giant Pioneer Natural Resources earlier this month for $64 billion. For more on the mega deals, we now turn to Andrew Dittmar, Enverus Senior Vice President. So, Andrew, let me first get your take on these headlines we're seeing. What explains, do you think, Andrew, this flurry of activity we're seeing? Any common themes?
Yeah, sure. So these are the majors stepping back into the market after 10 years where you really had fairly minimal spending on global growth and exploration. Oil and gas is really profitable business lines for them right now, and they're looking to get back to adding assets both in U.S. shale and now internationally with Chevron buying Hess.
Andrew, we're looking at the premiums on these deals that are not huge, but that's in part because the stocks have already climbed so much. So when we look at the oil majors that are left that have not made big acquisitions and what they're willing to spend, what does that mean? Like, are the mega deals done? Was this the last one of this kind of size that we can expect?
Yeah, I think we definitely see more consolidation, but in terms of deals of this scale, Exxon and Chevron were the two big buyers. Exxon buying Pioneer, not particularly surprising. They've been rumored for several months now. They're very focused on the Permian. Chevron buying Hess, a bit more surprising. When we look at the other companies that could do a deal of this scale, there's really not another logical big buyer out there. The European majors, BP, Shell, they're a little bit more focused on the energy transition side of the business, maybe a bit more pushback from their investor base and local governments if they were to announce a mega oil and gas deal. And then you step down to the really big U.S. companies that aren't majors. Conoco, already an active buyer in past M&A cycles, buying Concho a few years back, as well as Shell's shale assets in the Permian. EOG tends to favor a bit more organic exploration. So I think that really this is probably the last of the mega deals. What you're going to see from here is more of the large independents. So think the Devons, Marathons, and Coterras of the world looking at M&A, either potentially merging with one another or looking to roll up some of their even smaller size rivals.
And Andrew, on the Chevron Hess deal in particular, I'm just curious, do you think regulators will have any questions or concerns on that one?
No, I think in terms of getting approval, they should be in the clear. So a few more steps to go through with international assets. We need approval both in the U.S. and I imagine in Guyana, although having Hess sell to Chevron, a very financially stable partner, shouldn't be an issue there. There were some potential antitrust concerns around some of these big in-basin consolidation plays. We'd seen the FTC step in and be a bit more active in some of the smaller deals that were announced last year. And so there was a thought with Exxon buying Pioneer that could potentially come under heightened regulatory scrutiny, but we don't anticipate that happening. Even with Exxon and Pioneer put together, you're only going to be looking at them having about 15% of the production in the Permian. So fairly small piece of a very large U.S. unconventional pie. Here, there's really not much in the way of asset overlap with Chevron Hess. Chevron's going to be stepping into the Bakken, where they don't have any shale assets, a little bit of overlap in the Gulf of Mexico, and then moving into Guyana. So I think from a regulatory standpoint, they're probably in the clear here.
Andrew, to take a step back and look at sort of where we are in terms of oil demand in the world, in terms of a globe where many governments are trying to move away from reliance on oil, move towards electric vehicles, et cetera. Do you see these types of mega deals as defensive or offensive? Like, how should we contextualize them in this world of trying to move away from petroleum fuels?
Sure. I think what it is a recognition by these companies that we're going to need these fuels well into the 2030s. They're extremely profitable businesses, and they need to maintain and even potentially grow those lines. What they are focused on doing is making that energy that we need as low carbon intensive as they can. So from an overall emissions standpoint, I think rolling these assets up under the majors is a positive. Exxon has ambitious plans to cut the emissions from Pioneer's operations in the Permian, targeting net zero scope 1 and 2 by the mid-2030s. They're also building a carbon sequestration business. Chevron also is looking to reduce emissions from the Hess Bakken assets. So they're looking to provide the energy the world needs in terms of oil and gas while keeping emissions as low as they can.
And what is all of this going to do to the profitability and the growth prospects for, let's talk about these two big deals, right? For Exxon and for Chevron in making these deals.
Yeah, so profitability is really high for oil and gas businesses right now. They structured themselves to run in a very lean, oil price environment. We had a lot of volatility over the last 10 years. And they've now built up to where they're cash flow machines, and they need to maintain that machine. So it's about duration now for investors. How long can you maintain those sort of premium margins? We think that oil price is going to be there in terms of where we're at now, thinking 90 or $100 long term. And so it's what is your asset-based quality and what are the margins you're going to generate on those assets. So the companies are looking to high grade their asset bases to maintain profitability. Permian's a great spot to do that with Pioneer stepping in, or Pioneer's asset base for Exxon, adding more high quality shale inventory. Guyana is an extremely high quality asset for Chevron. And so it's going to maintain those profit margins as they move forward. And again, after that sort of underinvestment we had 2014 through 2023 in global exploration, it's making sure that they can, at minimum, maintain the declining production base that they have on their books and even look to grow those volumes and capture more cash flow.
Andrew Dittmar, thank you so much for your perspective on all this really helpful stuff. Appreciate it.
All right, sure. Thanks for having me on.